What do emerging markets? They have a great year. Let's say they're up 50%. Bitcoin going to be up 300? First part of the bull market is always led by Bitcoin. We did get one breakout, which was Solana, because it had its own adoption story.
When considering investing in Solana for 2024, it is important to look at its performance over the past few years. Since its launch in 2020, Solana has seen notable growth, notably in 2021, where its price jumped by more than 9,000%. Solana has several use cases such as Web3 gaming, NFTs, DeFi use cases, and crypto revenue opportunities. Given the growing development of networks and use cases, Solana is one of the best investments you can make to benefit in the long term. In today's video, we will tell you about Raoul Pal's view on Solana, as he thinks that people will regret for life if they miss the bullish move of Solana in 2024. But before we get into the video, make sure you subscribe to our channel and press that bell icon to never miss an update. The pace of change is what matters most, not directly, and the rate of change of liquidity improved throughout the year. And by most liquidity measures, whether using headline M2 or other liquidity measures, we have seen continued improvement. On top of that, using balance is a real asset. And we've seen snippets here and there of using balance. But that was not the major factor. The main driver of this development has been net liquidity measures in most countries. The Fed's net liquidity corresponds to the three main pillars of liquidity in the United States because the United States is the main driver of liquidity. Liquidity has increased this year. The Federal Reserve's net liquidity has increased 12% this year. This has been a multiplier effect due to downgrade effects and simply overall liquidity. Of this, 12% comes, 20% from the S&P, 48% from NASDAQ, and 150% from crypto. Thus, financial conditions are ahead of global liquidity by another 5 months. And financial conditions corrected to some extent as stocks corrected, or certainly the NASDAQ, and so on. But now they're going up as the dollar goes down. Commodities go down, and rates go down a little bit. Therefore, global liquidity is expected to continue increasing in 5 months. Global rates were reset to zero in 2008, and all governments are refinancing all their debts over 3 to 5 years. So we get this perfect 4-year cycle that repeats this perfect 4-year cycle, which suggests that global liquidity will continue through 2024 and 2025. Now, it won't be perfect, but it appears to be the case because of election years. In China, a deflationary crisis is underway, and it will lead to more liquidity. The Europeans see themselves this way. They will be the first to lower rates, so there is liquidity. The UK will do the same at some point. In this case, the Fed's main liquidity drivers, the Bank of England, the ECB, the People's Bank of China, and the Bank of Japan, have been easing their control of the yield curve all year. We'll see what they do too. People are confusing current economic conditions with the recession they desperately want and the markets that reflect it. Forward-looking things like cryptocurrencies and technology they discounted in 2022. They all have bear markets raging right now. We have the Russell 2000, oil, copper, all these things. We are therefore at the lowest point of the cycle. This does not mean that inflation will now increase. With inflation lagging far behind due to rents and equivalent salaries for landlords, it is expected to continue to deflate throughout 2024, particularly at the central level. And we think the general level continues to decline, so we still believe that headline inflation will probably reach zero next year, as will core inflation, which we think no one is prepared for because everyone is in the camp of inflation. Worry about inflation during the next business cycle when it warms up, not at the start of the business cycle. It's macro summer. The transition from spring to summer typically involves lower inflation and higher growth, and that's what we're seeing. Everything that awaits us is from macro spring to macro summer. So we had the lowest point in the ISM. All the forward-looking indicators that point to the dominoes of the business cycle mean that the things that the Federal Reserve is looking at, inflation and unemployment, are the last shoes to drop, which is why that they have been very slow in this cycle. So what you will see is that unemployment will increase a little bit. No one expects a massive increase in unemployment, but a bit more serious. AI and other things like that will make things harder, and most of the jobs lost in Silicon Valley will come back. So people have to reorganize and find different jobs and that sort of thing. Then inflation will remain low for at least the next year, and then it will start to pick up again, as it does with all economic cycles. Inflation will rise next time. Liquidity first stimulates assets, and the economic cycle determines the rest of the assets. So if liquidity continues to improve, and there will be ups and downs and so on, then tech and cryptocurrencies will continue to outperform. But for those who don't like the top of the risk curve, 2024 ultimately becomes very interesting for all small caps, for all emerging markets, because the dollar is also expected to weaken. Finally, everyone who works in the commodity sector has had a false start in the oil sector. We should therefore see a rebound in traditional cyclical cycle economies if we face a gigantic delta risk on risk outside the world based on the global debt cycle. Then there is no benefit from diversification. What are emerging markets? They're having a great year. Let's say they're up 50%. What will cause Bitcoin to rise by 300? Cryptocurrencies are really interesting because people think of them as some kind of weird, fun internet money, and they have no relation to anything else. This is pure macro. This aligns perfectly with the global liquidity cycle. Its risk curve corresponds to the same liquidity cycle as the risk curve of bonds, for example. So at the beginning of the recovery process, what you tend to see is that the treasuries recover first. We then tend to move away from the risk curve, and then 2 years later, everyone is making subprime loans to the private sector in the local market of the world's worst emerging markets, looking for risk. It's the same in crypto. So the first part of the bull market is still led by Bitcoin. We had a runaway, which Solana did because she had her own adoption story. But what happens is when year over year global liquidity becomes positive, and it's very close now, that's when the risk curve activates. That's when Ethereum starts to outperform Bitcoin, and we have what's called an alt season, which is the smaller tokens, because people are just moving out of the risk curve, which also corresponds to the Bitcoin ETF. So Bitcoin ETFs, they're all leading the way. And then everyone, once the dust settles, then comes Ethereum. Now Ethereum is half the size of Bitcoin, or even a little smaller. So if you invest the same $1 billion in Bitcoin and then transfer it to Ethereum, it will have a huge effect. So it's the same cycle. The same cycle as the global debt cycle is exactly the Bitcoin halving cycle, which is also the election cycle. They are all the same. And the global rate cycle is part of the same phenomenon. They are all the same. That's why it's a gift. There is no need to diversify because they are all the same. So just choose the assets accordingly, depending on your premises at risk. We assume that central banks will use balance sheets to finance interest payments. Perhaps this will not be the case, and therefore there may be less currency depreciation. The increases in asset prices are therefore not as strong. But we didn't use a balance sheet in some of the other code cycles, and asset prices were still quite high. So we still think there is liquidity. We just don't know what kind of liquidity. Election cycle years are always positive because there will always be an incentive to bribe voters. So going against that, going against the forward-looking economic cycle is a very difficult decision. You would do it because you emotionally want a bear market or recession, not because the data leads you to believe it should be that way. So that's how it is. Maybe we'll have a recession, maybe not. But anyway, at first it must have looked more like 1990. That's all for today. Let us know your views in the comments section below, and don't forget to like this video before leaving. Thanks for watching.